We will discuss bond valuation, bond security valuation. What do we mean by a security? A security is a contract which promises future cash flows. So if we draw the timeline like this, consider the following bond security with the following features. So over the next 4 years, this security promises the following cash flows. It promises, say for instance, $10 at the end of year 1, another $10 at the end of year 2, $15 at the end of year 3, and $20 at the end of year 4. So such a security has to have a positive value today. So if you want to receive those cash flows, well, you will have to pay its price, right? So clearly this is a security which offers some positive returns in the future, and as a result it would have a price. So for you to entitle for those future cash flows, you will have to pay the price for that security. So when we say a security, it's any financial claim. Let's write that down. Financial claim that promising future cash flows. That's it. Future cash flows. And because those cash flows in general are positive, though there might be some years where the cash flows might be negative, but in general they have to be positive. And if they are positive, they have to have a price today. You have to make a payment to be entitled to receive those future cash flows. So once we define the security, a security in those broad terms, we can start talking about a bond security in particular. There are two types of securities. Let me write them here. Two types of security contracts. The first type is bond securities, which we usually call them as debt securities. An example will be bonds. And the second type is equity securities. Equity securities. And we usually refer them as stocks. All right. So they have different cash flow features as well as some other features that distinguishes those two types of financial securities. Investors in general, they invest in those securities today. They pay the price today so that they receive those future cash flows. Just as an example, an annuity will be a debt security type of security, right? So an annuity is, you have a pension plan. Let's say that you put on money into your retirement account for years, and at the age 65 you decide to retire. At the age 65 you have accumulated $1.2 million in your retirement plan, in your fund. So what you want is, at that point, with that money that have accumulated in your pension plan, you want to purchase an annuity, a security which will pay you certain cash flows over the next 30 years, for instance, something like that. There are a variety of securities, obviously. In our purposes, usually the way we look at this transaction is from the transaction being initiated by a company which needs financing for a project, and that company can find that financing from the general public, from investors. So the only way the investors will pay the firm whatever money they need, the funds they need to invest in those projects, will be by selling bond securities or stock securities to those investors. So the firm sell those securities to the investors to raise money today. So that price that you pay to purchase the security will be used by the firm to invest in various projects, and hopefully those projects will be profitable projects. They will create cash flows for the firm, a portion of which the firm will pay back to investors, for instance. Right, so that's kind of the key logic behind it. So because we said there are two types of securities, in this video I want to talk about valuing debt securities, and in an upcoming video I will talk about valuing equity securities. And ultimately our goal in this week will be to understand the sensitivity of bond security prices to different variables. Sensitivity of bond prices to changes in maturity, changes in interest rates, changes in coupon payments, and so on. But first, let's start with a generic example. So we have a bond security. So what makes a security classified as a bond security? Well, a couple of features, and let me first write down the features, and then we can explain it on an example. So the features will be, first of all, like we said earlier, they are debt securities. So the type of the contract is a debt security contract. So in a sense, you are a creditor. So the bondholder, the investor or the creditor which purchases the bond security from the company is purchasing a debt contract. That contract means the investor, the bondholder, have priority in terms of payments. Whenever the company makes profits, the bondholders are the first in line to receive payments. So they have priority over stockholders to the cash flows of the firm. So if the company does not have enough cash flows to pay back bondholders and stockholders at the same time, it will be bondholders which will be paid first. All right, so bondholders have priority. Bonds precede stocks in terms of priority. But the problem is there is no upward gain, right? Stocks get all the upward gains, and in terms of risk, yes, bonds have less risky because they are paid first. However, in terms of returns, potential returns, stocks offer a higher return because they are so much risky. So any upward gain, in the sense that if the company becomes extremely profitable beyond expectations, only stockholders will be paid for that risk that they've taken. Bondholders will not be compensated further than those cash flows promised by the bond. Bonds are limited time, so they have what we call as maturity. And at maturity, the bond pays what we call its par value. And it also, the bond also pays along the way. So if the maturity, say, is a 5-year bond, every year until year 5, so year 1, 2, 3, 4, 5, the bond will pay what we call as coupon payments. All right, so which is a percentage of the par value. Finally, we need to also consider that, like we said, we need to purchase the bond, we need to pay a price. The price is usually referred to in comparison to the par value. If the price of the bond is exactly equal to the par value or the face value, actually this is a more accurate. Sometimes they call it par value, but oftentimes they call it the face value. At maturity, the bond pays a face value. So if the price of the bond, you need to pay the price to purchase the bond. If that price is equal to the face value, we call such a bond as it's selling. This bond is selling at par. Versus if let's scroll all the way up. If the price is less than the face value, then we would say that the bond is selling at a discount. And finally, if the price exceeds the face value, it will be that the bond is selling at a premium. In general, though, the price, the market price, will be very close to the face value. So if the face value is $1,000, the price will be fluctuating between $800 and $1,200, I would say. If it's in the range between $800 and $1,000, that would be a discount bond. If the price is exactly $1,000, which is very unlikely, it's a par. And if it's selling at par, and if the price exceeds the face value of the bond, then it's that bond is selling at a premium, basically. All right, so let's put all this into a timeline. Usually this is the way we represent bonds. So if you have the timeline, suppose that you have a 5-year bond. A company recently issued a 5-year bond to borrow money from the public, from bondholders, and the bond, let's say, is selling at $975 today, and in return the bond is paying $50 year after year in coupons, and at the final year it's paying back its face value. So as you guys can see, that $975, let me just put it in another color, in red color, because you are making a payment, I guess, minus 975. So by paying this price at time 0 today, basically, you are entitled to receive all these cash flows over the next 5 years. Then a good question would be, what is the expected rate of return for that bondholder? What is the rate of return that the bondholder will earn by holding this security, right? So this expected rate of return is an annual return that we can calculate. And if that return exceeds the required rate of return, so this is the reservation price, or reservation rate of return, I should say, rate of return of the investor, so or creditor, you can call it, maybe credit. Usually investors are related to stockholders, versus in this case we can call it creditors. Usually creditors are associated with bondholders. Okay, so I hope this makes sense now. So we have a security which promises all these future cash flows: $50 at the end of year 1, $50 at the end of year 2, $50 at the end of year 3, $50 at the end of year 4, and a combination of 50 plus 1,000, so $1,050 at the end of year 5. Overall, this bond pays about $1,250 in a 5-year period, and because the price is less than $1,250, this bond will definitely have a positive return, so no doubt about that. So this rate of return will be positive. However, what we are saying is only when the expected rate of return, which we are about to calculate, exceeds the reservation rate of return of the creditor, it will be an attractive investment for the creditor, and the creditor will invest into this security. Otherwise, the creditor will not be tempted by this security, basically. So having said that, we can just go ahead and make the calculations. So basically, the expected rate of return of the investor will be just the rate of return which will make the present value, the discounted present value of all these future cash flows, equal to the price of the bond, which is $975. So sometimes this is also referred to as yield to maturity, YTM. And yeah, so that's reasonable. So what is this number mathematically? So I will first provide a formula, which I doubt anybody will use because the formula is a little bit difficult formula. And the formula says the following: 975 is equal to, so well, all these $50 payments will be discounted at the interest rate, which is the yield to maturity, YTM, plus that second $50, that one will be discounted twice at that yield to maturity. So that's why I will divide it by squaring this, and so on. So the third $50, the YTM, the rate, qubit, $50, 1 plus YTM, fourth power, and finally in the last year we are receiving $1,050, 1 plus the YTM raised to the fifth power. So we need to solve this equation for YTM. This is the unknown. YTM, the yield to maturity, is just the expected rate of return of this security. Obviously, mathematically speaking, this will be almost torture to try to solve this fifth-degree polynomial. Instead, we will use Excel to do it, and let me just go ahead and open Excel next, and in Excel we should be able to pretty efficiently make the calculations, basically. Okay, so I just copied our progress so far. So on the timeline we have a bond which promises $50 coupon payments over the next 5 years, and at maturity at year 5 it also pays an additional $1,000 face value. And currently this bond is selling at $975 at the marketplace. The question is, an investor who invests in this security, a creditor which invests in this security, how much rate of return is that investor earning over the next 5 years by simply purchasing this security with the following cash flow promises. All right, so the way we usually do it is the following. We need to summarize all the givens, and in general there are 5 features. So we have the rate of the bond. That's what we want to calculate. We decided to call it the expected rate of return. Next is the number of periods. So this is a 5-year bond apparently, right? So we can write 5 here. Then is the present value, which is the price basically. So we can just PV. That's the price is, we are told $975, but because it's a cash outflow, I put a minus sign in front of it. Then we need to figure out the coupon payments. I can just call it payments. The payments are $50 each year for the next 5 years. And finally, the face value is $1,000. So these are the given features of the bond. Actually, it would be even better if we write it that way, features of the bond. So now let's go ahead and value the expected rate of return of this bond, right? So I'll write the result right next to it here. And there's basically 2 ways to do that. So arguably the easier one would be the following. You go to the formulas ribbon on top in Excel, and under financial, you just find the rate. You scroll down in the formula sheet, and there you go, so rate. As soon as you press rate, it is opening a dialog box, and we should be able to fill in the numbers from this dialog box. Okay, so the question mark is at the rate. Next is number of periods. So you can directly refer to the cell here, or you can click on this and look closer right here, this number. This is number, so and then I can click back this. Then the payments. Alternatively, you can directly click it. As long as the number shows up, you're in good shape. The present value, the current price of the bond, the future value of the bond, and that's pretty much it. So we're ready to click OK. Before I click OK, look at that. There's a number showing up here already. So that's telling you the answer, and which is 6%. I can actually go ahead and add more decimal places of accuracy. That's a percentage. Add 2 more. So it's really 5.59%. So the investor, by investing in this security, this is the expected rate of return that the investor is expected to earn by simply investing expected rate of return. So the investor is expected to earn 5.55% return on this investment. Now, if the investors, the creditors' required rate of return is say 7%, then the investor will not invest in this security. He or she will think that there's not enough return, right? So if, okay, hypothetically, if creditor A has a 7.25% required rate of return, then that investor will say no, don't invest, don't invest. So that investor A, creditor A, will not invest. However, if there's another person, creditor B, has a say 5.15% required rate of return. So the required rate of return is the return that is attractive enough for a creditor to invest in a security. So if creditor B has a 5.15% required rate of return for this bond, then this is an attractive investment. Why? Because the expected rate of return of this security is that this security offers is 5.59%. Then yes, invest. Right? So the same security with the following cash flows, creditor A says, no, I don't want to invest. Creditor B says, yes, I want to invest. So they need to give an answer based on a comparison of what the bond is promising. So this is the promise of the bond. The bond is promising 5.59% return on any investor who purchases this bond. Now it is the creditor or the investor's turn to make a decision. The decision will be based on his or her reservation, required rate of return basically. This is the least return that will entice the creditor to invest in this security. 5.25% for creditor A, 5.15% for creditor B. All right, so that is the positive side of the story. Now the story also have a normative side. So for creditor A, 5.25% is the required rate of return of creditor A. As a result, he or she decides not to invest in this bond, presumably because that investor thinks that $975 market price is too expensive. So this bond is too expensive. Then the next normative question will be, what is the value of the bond to creditor A? That's the next question. So this 5.59% is the expected rate of return that the bond is promising, investors or creditors. This is a positive statement. So 5.59%, if you pay $975 today, and if you receive those cash flows in the future, $50 each year over the next 5 years, as well as a $1,000 additional payment, then you are promised to receive 5.59% rate of return. So this is a positive statement. Now we have a normative statement. Normative. So what is the value of the bond after all? Let me write the question. What is the value of the bond to, say, creditor? I think we decide to call it creditor A. After all, well, creditor A, we know, has a required rate of return of 7.25%. And the same question for creditor B. Control C, enter. We can just, so creditor B here, the required rate of return is 5.15%, right? 5.15%. Again, the same question. What is the value of the bond for creditor B? How do we answer these type of questions? It turns out that the answer is using the same tools that we used. So let me put that one over there. All right. So I'm just going to write down the givens again at the bottom. So the rate, the number of periods, the present value, the payment, and the future value. And let me just go ahead and copy these over here. So this time we will reinterpret the question as following. The present value is really the question mark, where the question mark is, the value of the bond. So the outcome here will give us the value of the bond, versus the rate will be interpreted this time as the required rate of return, which is 7.25%. The number of periods didn't change, the payments didn't change, and then the face value didn't change. So can you compare this givens with those givens? They are almost the same, with the exception that instead of asking the rate, here we were asking the rate given the market price. Now we say, given the required rate of return, what is the value of the bond to the investor? And sure enough, we can just again go to the dialog box, because the question is asking for the present value, which is the value of the bond after all. So we just, under the formulas, financial formulas, we scroll down until we find the formula for present value. The rate is the required rate of return. Let me scroll this up. There you go, this number. The number of periods didn't change, it's 5. The payments is 50. And the future value of the bond is $1,000. So when we press enter, okay, that's it. $908 is the maximum price that creditor A is willing to pay to purchase the bond. Right now, the bond is selling at $975. As such, the creditor A thinks it is overpriced. 908 is less than 975. So this is the current market price, right? So as a result, no, don't invest. Do you guys see how we answered the same question from a different perspective? We call this the normative perspective, versus the previous one. This one was a positive perspective. From the positive point of view, you pay $975 today, you receive those future cash flows, you're expected to earn 5.59% rate of return on your investment. Versus in the normative case, given my current required rate of return, what is the value of the bond to you, to the creditor A in this case? We can answer the same question for creditor B as well. So I can just plug in the values for creditor B. The required rate of return of creditor B is this much. 5-year bond. The present, that's what we need to answer for creditor B. $50 payments and $1,000 face value. So this time, again, we go to formulas, financial. We scroll all the way down to present value. There you go. And we plug in pretty much the same numbers. 5.15% here. The number of periods is 5. The payments are $50 and the face value is $1,000. Press OK and boom. So because this number is in excess of $975, so $975 is the market price, and this investor is willing to spend up to $993. This is his how much he values that security. So the answer is yes, invest. So creditor B says yes, invest, simply because he or she values the bond higher than what the market values. And creditor A says no, because he or she thinks that the bond is overpriced. All right, so now that we are done with valuing bonds, next step is to see how sensitive the price of the bond is to changes in interest rates.